Why have taxes? We're going to talk about taxes now. Well, to have a civilized government, government requires taxes, it requires revenue, and taxes are one method of paying for the services we receive, building roads, highways, schools, traffic lights, a whole variety of services government provide to us. You'll know something very important about taxes if I compare them to voluntary trade. Taxes are coercive. That means to say that you have no choice, you have to pay them. If you decide that you want to buy a Big Mac, well, you choose to buy it or not buy it. It's up to you. But in the case of taxes, you have no choice. There are a variety of ways of avoiding. We'll look a little bit at this. But basically, if you're living in the jurisdiction, you could leave the jurisdiction. You could leave, for example, Quebec and go elsewhere, but you're still in Canada. So you have to pay taxes to the federal government. Potentially you could leave the country, although interestingly, in the United States, for example, if you are a U.S. citizen, you still have to file an income tax, regardless of where you live in the world, as long as you are a U.S. citizen. You may recognize this guy here. He was a bad guy, a gangster. His name was Al Capone, and very famously he went to jail. But he didn't go to jail because of his gangsterism or mafioso, his fact that he was ordering the killing of people. He went to jail because he didn't pay his taxes. This is an important point about the tax system, meaning it's coercive. In Canada, it's known as, the federal level, it's known as the Canada Revenue Agency, CRA. In the United States, it's known as the IRS, or Internal Revenue Service. They have tremendous powers. Not only can they put people in jail if they don't pay their taxes, but in addition, they can seize assets, they can freeze bank accounts. Tremendous amount of power. If a person declares bankruptcy and can't pay other people, they still owe this money to the revenue, to the CRA or the IRS. Kind of an interesting point to consider is the comparison of the idea of tax compliance versus voter turnout. And people often measure a democracy by whether or not voters are actively involved and citizens are actively involved in the democratic process. They go to elections and so on. My own personal feeling a little bit is tax compliance might be a better measure of whether a society is civilized or not, because tax compliance, in effect, refers to whether people voluntarily, whether they pay their taxes or not. Many people try to avoid taxes legally or illegally, and this measure of tax compliance, most people in North America in general pay their taxes. And so the Canada Revenue Agency, while it has the authority to do these things, they don't generally have to, because most people accept, and this to me is a measure of a civilized state. People accept the fact that they have to pay their taxes. I want to finish with a little point here, the difference between something called tax avoidance and tax evasion. Tax avoidance is perfectly legal. It's something that you do to avoid paying a tax. Examples, there's lots of examples, but I'll give you two here. Something called a TFSA and something called an RRSP. And I'm going to talk about this at the end of the next lecture. What the difference has been and how these can be used. But these are perfectly legal ways in which people reduce their taxes. Tax evasion, on the other hand, is illegal. This is the kind of thing you go to jail for. A typical example would be not declaring your income. For example, there is an income tax. You have to pay tax on this income, and every year you have to file a statement indicating how much your income was for the year. And if you do not declare certain income, then that's considered tax evasion, and this is what can cause all kinds of problems for a person. Now, there are many types of taxes, of course, but from an economic standpoint, they can broadly fall into two categories. And I want to look at these two. One is historical. The other is more common in the present, although they both exist in Canada. One is called an excise tax, and the other one is referred to as an ad valorem tax. The excise tax is also known as a stamp tax sometimes. It refers to a tax that's per unit. So it means that it's a tax on a particular thing. The second type of tax is a tax by value, which means that it's based on the value of the purchase, whatever it is you happen to be buying. Some examples might illustrate this better. An example of we still have this tax. We have a federal excise tax in Canada, 10 cents per litre of gasoline. That means to say if you buy 10 litres of gasoline, you have to pay 10 cents for each litre. It doesn't matter what the price of the gasoline, how much money it's per unit. Another example is there's a $55 federal tax on every airline ticket. Doesn't matter where you're flying, doesn't matter what the price of the ticket was, first class, business, tourist. It's a per ticket price. That's an example of an excise tax. These taxes, there's not many of them now, but they used to be very common in the past. An ad valorem tax is by value. So, for example, if you go to a Dollarama and you buy something, you pay 15 cents, $1.15. That's the combined GST and PST, which is 15%. If you buy a big TV at Best Buy, well, then you pay $1,000, but you pay $150 for the sales tax. So that means to say the sales tax is based on the value of the item you're purchasing. Income tax is another example of an ad valorem tax, where the percentage is based on what your income is. People that earn, say, $1 million a year are going to pay a certain percentage, say 30, 40%, $300,000, $400,000, whereas a person that only earns, say, $50,000 is going to pay a smaller amount. And in actual fact, in the case of the income tax, the percentage changes. But the key distinction here is whether it's a per unit tax or based on the value of the item you're purchasing, or whatever the activity is. Historically, excise taxes were very common. And they're still common in poor countries, in part because it's just easier to count something. It's a little bit more difficult to calculate the value of something. And in particular, it's probably easier to avoid it because you can declare the value as something nominal. Almost every port around the world, Montreal's no exception, I've got a photograph here, has a customs house, typically built around the 18th or 19th century. It would be a major building right at the port because this was a method of collecting taxes. It was an excise tax. Any ship that arrived, any boat that arrived in the port would have to go and pay the excise tax on the bottles or items that were on board the ship. You can go and visit. I think this is a museum now. This customs house. As I say, over time, governments in Canada, for example, rely less and less on these excise taxes and much more on sales taxes, or ad valorem taxes, rather. Okay, so let's consider I'm going to consider an excise tax. It's a lot easier to understand in terms of graphs and shifting things around and so on, rather than an ad valorem tax. So I'm going to use the example of an excise tax, and imagine that it's applied, let's say, on dairy farmers. Go back to my milk example. Dairy farmers in Quebec. So we'll say that the government. Let's write the government like this now. GOV like this. Imagine it applies an excise tax on dairy farmers. That means to say, it's sometimes referred to as a farm gate tax. Every time a liter of milk leaves a farm, the farmer has to pay 30 cents to the government. So we've got the equilibrium before, and we could have said, well, what curve is going to shift? Well, this is a bit like the toll to bring the milk into Montreal. So we'd expect that the supply curve would shift to the left. And so here we go. There, we've shifted it to the left. It creates a new equilibrium where the price of milk is higher, makes sense, and there's less milk bought and sold. So far, so good. But this shifting of the curves here hides a really critical fact about a tax. And the fact is that the tax creates, in effect, two prices. There's a price that the seller receives, and there's a price that the consumer, the buyer, sees. So these are two different numbers. And I want to take this idea a little bit further and examine it more. If you think of it, the buyer is going to pay one price, the seller, the dairy farmer, receives something else, with the difference being the tax. So, for example, if you go to Dollarama and you purchase an item, if you find an item there that's $1, well, you don't pay $1. You're going to be paying $1.15. Why? Because, well, there's the sales tax. The difference between the 15% is going to be the GST, which is 5%. And I think the provincial Quebec tax is about 9 point something. It turns out to be roughly 15% combined. So that means to say that the Dollarama store only gets to keep $1. And the 15-cent difference is the money that goes to the government. This may sound like very small, but of course, if you're buying a big ticket item like a car or a big TV, well, then it becomes significant. Important point to notice, of course, is that the I'm going to call this PC, is the price that the consumer pays, of course, is the greater. The producer, the seller price, what they get to keep is $1 is going to be the smaller of the two numbers. Economists refer to this as a tax wedge because, in effect, what it means is what you as a buyer see, the signal is different than what the seller sees. So we're seeing two different things. And this is actually a source of people making a mistake. It's a bit like if you show up at a traffic intersection and you see one light and the trucks see a different light. So we're not seeing the same thing. And this is a source of inefficiency. And this is the reason ultimately why economists don't like taxes. It's not that they don't want the government to raise revenue. It's rather that it creates this distortion. So the price signal doesn't work properly. And a society can be inefficient or wasteful. And economists come up with various ideas or concepts, schemes, in order to reduce this distortion. You can imagine the distortion a bit like this. If you have something in a swimming pool or in a glass of water, it appears as if it looks as if it's two different items. Another way to view this is if you have a job, you're working part-time, you receive your pay statement probably as a PDF file, maybe by email, and often you will just look at the number. Typically it's down here in the bottom right-hand side. That's your net pay. That's the number you care about because that's the amount of money that's going to be put into your bank account. But your employer doesn't see it this way. What your employer sees, or what is concerned about, is worried about, is usually another number somewhere on the left, on the upper side, up here, for example, which is your gross pay. This is the amount that your employer has to make sure is available for when they do their payroll, when they calculate the revenues, the money they have to pay out to their employees. This is critical for them. So in effect, you're looking at two different numbers. You see one number, your employer sees another number, and this is an example too of what's called a tax distortion or tax wedge. So I want to look at this idea of two different prices a little bit more clearly in the case of the milk. So here again, what I've done in this case is I've drawn the graph but a little bit more precisely. So we've got the exact same example we had before, where we had an equilibrium at $2.60 and there was 30 million liters of milk bought and sold. So in this case, I'm going to impose now an excise tax of 30 cents on the dairy farmers. So let's start here. I've got the tax of 30 cents. You'll notice it's exactly equal to 30 cents, vertical distance. We know that. If you sort of look at the lines here, I've drawn it perfectly so that the upper one is $3, the lower one is $2.70. So the difference between the two, the vertical distance, is exactly 30 cents. And what I want to do is take this tax of 30 cents, this red line, and slide it in precisely between the demand curve and the supply curve. And you'll notice it will only fit in one particular place. So let's try and do that now. I'm going to move it over here. Make sure you slide it in on the left-hand side between the two. And if I do that, it'll fit just in one particular place. You can't fit it anywhere else, as long as you've got it exactly at 30 cents. And here now we can see that the consumer price is the one at $2.80, and the seller's price, that means to say the amount of money that dairy farmers are going to receive, is $2.50. We can sort of see this down here. This is the $2.50. This is the price that the consumers pay, $2.80, and the difference between them is 30 cents. You'll notice too now, of course, as before, that we've got less milk bought and sold. There's only 25 million liters. I'm going to look at this in more detail in the next video. We want to see, well, what does this mean exactly? But we've clearly found now the two different prices.